Hello and welcome to my morning note. The honeymoon is over for Shinzo Abe, the Japanese Prime Minister who is here in London at the moment. But is there any greater damage to his relationship with the markets than that? That's the topic that I'd like to discuss today with my guest, who thankfully is just back from a week spent in Japan talking to financial institutions. He's the head fund manager for the AXA Framlington Global Opportunities Fund, Mark Tinker. Mark, thanks very much for coming on the video.
Pleasure.
Let's start with the fairly dramatic chart of what's been going on since Abe took control. Obviously, there's been somewhat of a reassessment in the markets, to put it mildly, in the last few weeks. Plainly, also the upward trend still just about remains intact. What do you think has gone on in the last few weeks?
In the new year, people like myself, longer-term investors, said, well, actually, if the economic policies really are going to play out as we think and hope they are, then this is a case where actually now we've seen a big sell-off in the yen. We haven't got that currency risk so much. So what we're going to do is try to invest in people that benefit from what's now known as Abenomics. Yeah. So you then got institutional money started to come in around about here. Then the final blow-off, if you like, was that leverage money coming back in again, playing momentum. And it was all looking very, very twitchy, waiting for a trigger to take profits. And that's
what
really
do you think
what's
that
happened.
Trigger was? Is that one of the many things we can blame Ben Bernanke for, or was there something domestic?
Well, there were two things really. First of all, domestically, the government pension fund suddenly found itself heavily overweight equities just because of how well they performed. And they're not looking for an expected return, they're just looking for a risk weighting. So they reweighted. So suddenly you had a seller. Now that then came at the same time as a lot of those leveraged hedge funds were really being told by the Fed, don't build another bubble, don't play carry trades, don't play large gear positions. So they didn't need any more excuse but to take some of their money off the table. And that's affected other markets, it's affected emerging markets as well. But to the extent there was that leverage money playing in Japan, that's caused that sell-off in the last couple of weeks.
Now let's take a look at another variable that has worried quite a lot of people, which is JGBs, government bond yields. Plainly there's a very dramatic jump in May that had people worried that the government was losing control of this, that those rising yields could undermine everything else that was going on in Abenomics. Is that now under control? What's happened there?
It does look like it has. As you can see here, the JGB yield was very flat until at the beginning of the year, just as the institutional investors started thinking about equity. So they started thinking people started thinking that the government was going to buy back bonds again, just like QE in the US. That drove the yields to very, very low levels. And then when the actual announcement came at the beginning of April, which was Big Bang, as they call it, which is effectively QE1, QE2, QE3, and Operation Twist all at the same time, instead of going down anymore, everybody got too far. So we got a reversion there back to where things ought to be, and everybody bought ahead of the announcement. Then there was a worry that they'd actually lost control, but the government effectively said they would step up their rate of repurchasing. So they haven't lost control of the JGB market, which is very important to the longer term plan. Because John, this is a long term plan. This is a 5-year plan, and everybody's worried it hasn't lasted 5 weeks. It's a much longer term story.
Now let's talk about the dynamics of the local market, which are very different from in the States. Who is holding those bonds? Who is out there ready to buy further into this story? Where's the money going to come from?
Well, I think it's very important to recognise that the Japanese government has a big deficit, but it's all owned by the Japanese household sector. So what this story is really all about is Mrs Watanabe, the metaphorical housewife in Japan. And she has been very clever, the wisdom of crowds. She has had the perfect portfolio for a deflationary environment for the last decade. Now, what Abenomics is about, and what she is clearly already responding to, that's what I got last week, was a move to an inflationary portfolio. So they're starting to reposition. And the big number to bear in mind is there's $16 trillion in the household balance sheet in Japan. More than half of that is in cash. So only a small amount of that has to start to move around. You can understand it has incredibly powerful impacts on the markets within Japan itself, and that's what we're looking out for. That's why I was over in Japan last week looking at financial service companies who are obviously going to be some of the major beneficiaries from that. So it's the move to a no longer deflation, not a lot of inflation, but no longer deflation means real assets, means equities, means investment trusts, means property. Finding out anecdotally that 80% of new mortgages now in Japan are fixed rather than only 10% like 6 months ago. So I think the household sector understands it. And I think that genie is now out of the bottle, and I think it's up to the Abe government just to make sure that there are fewer barriers in the way for that whole process, which is the purpose of Abenomics to carry on.
Okay, Mark, thank you very much indeed.
Pleasure.
I think to conclude, we've learned many times in the past that you bet against Mrs Watanabe at your peril. You might not want to do things in too much of a hurry, given what we've just seen in the correction of the last few weeks, but in the longer term, if you stay with Mrs Watanabe, it does look as though there is still a very positive picture for Japan.